Welcome back. You are watching At the Open on the Sky News Business Channel. Now, as the big banks raise their rates and garner plenty of political and economic attention, direct lenders are next under the microscope. Internet-based home loan lender www.myrate.com.au says it's booked a 300% increase in daily inquiry volumes in just 1 week since the bigger lenders started passing on their higher credit costs. Indeed, we're joined now by Kevin Sherman from Myrate. Kevin, welcome to the studio. That 300% figure is quite incredible. Just what does that translate into practically in terms of a weekly number?
It's typically in the order of thousands of people now moving online to look at their home loans. I think with the big banks finally moving rates outside of a Reserve Bank cycle, many consumers have identified that there's very few benefits, if any, in staying with the major banks for their home loans.
Because you'd think, though, that you would have part of your banking with the main banks, and this would just be an add-on, your mortgage. There's a lot of certainty and there's a lot of, patriotism, or not patriotism, but patriotism towards, being with someone you know from day one.
Absolutely. A lot of Australian consumers reward the major banks with their loyalty. They typically opened up a banking account there years ago and it was the logical place to go and look for their home loan. Also, with the global credit crisis, a lot of people felt more secure in their funding with the Australian banks. But with the recent rate moves, a lot of people have identified that that's not necessarily true and have taken the next logical step in where to go, where we look for everything these days, which is a move to the internet.
Yeah. Lots of emotive thinking and language at this time. I mean, it inevitably becomes a personal issue and people are feeling the squeeze. But nonetheless, to talk about the big banks, quote, grab for cash. Okay, let's just sort of understand it factually. Margins have been squeezed. We know this. We know that JP Morgan said that the big banks are facing losses of up to $600 million. Really, how much of it is a grab for cash? How much of it is just pure business? We're losing out. We have no real option.
Absolutely. From the bank's perspective, I agree 100%. They do have a definite increased cost of funding, and that's across all lenders. There's no magic pot of gold out there that somebody stumbled across. But the reality is, they have to deliver profits to their shareholders and have to take the responsible business decision to ensure that that business remains profitable. I think the main difference is that if you look at the bank's operating model versus an internet-based lender's operating model, we've got way less overheads. We don't have a massive branch network to maintain. We don't have thousands of people to maintain in employment. So with the funding crisis being, representative across all lenders, there's always going to be this differential between internet-based funding and the major banks, just purely because of overheads.
Well, I was going to say overheads though is one issue. That's that is personnel in a bank versus the need to get wholesale funding, which, presumably you need to get as well.
Absolutely. That's why I said there's no pot of gold out there. We're funded by ING Bank and have constraints just like every other lender out there. However, because our overheads are so low, we can operate on a much lower margin. So the differential through all the credit crisis always remains. There's always going to be at least around 1% difference between ourselves and the main banks.
But, practically, how much have you had to pass on to the consumer in the wake of this squeeze on credit?
We basically have absorbed as much of it as we can. And
as have the other banks?
Absolutely.
So, in terms of dollar figures, how much have you had to pass on?
We haven't passed on anything outside of Reserve Bank rates at the moment.
Right.
So we'll look to our funder for guidance on that. So the main banks have moved their rates. We haven't had a rate move yet.
Is the operative word there at the moment? Are you suggesting once the RBA moves, you will?
If the RBA moves rate ups, I'm fairly certain that our wholesale funding will definitely move. I think whenever the RBA moves, all standard variable rates do move within that cycle. It's whether or not there'll be a movement outside of that cycle. That's the current question.
Now, you're talking there about variable rates. On your website, you list your rate alongside the big boys.
That's right.
What about the fixed rate? What percentage of people are now locking in and saying, OK, all this volatility, all these rises, we want to fix? And to that end, do you or do you not offer fixed rates?
Absolutely. We have the full range of home loans that are available. There's construction loans, fixed loans, variable loans. more and more people are looking for fixed loans, but if you look at some of the industry commentary, a lot of people believe that that's the wrong move to make at the moment. They believe we're towards the top of the fixed rate cycle, and that, if anything, maybe 1 or 2 more rate rises will come along, and then we might start heading down. And if you look typically at the standard variable rates are about 50 basis points below where fixed rates are. That means there's a margin there for 2 rate rises before you're even approaching that same level.
As if one more wasn't enough. Ken, thank you for your time. Ken Sherman, Myrate.com.
No problem.
Okay. We are going to take another break, but do stay with us. Plenty more when we return.